Hi, this is Stephen here from Share Navigator, and today we're going to share with you the short strangle strategy, one of my favorite strategies. So let's get to it. Here's the overview of the trade. This is what we're going to cover today, and if you want to pause that in your own time, look at the overview, we'll move on straight away. Okay, so the first thing, what type of a trade is the short strangle trade? It's a neutral trade. In other words, you don't care whether the share price rises or falls as long as it stays within a trading range. It's a credit spread. You're getting paid in advance to place the trade. It's best placed when implied volatility is high and you want implied volatility to decrease. Okay, so let's look at trade construction. It's actually two trades placed as one. It's the first trade is to sell a short put at a strike price which is out of the money. The second one is to sell a call option at a strike price which is also out of the money. We're going to go to their demo account and place a trade right now, but please note, only place this type of a trade on liquid options. It's very hard to make money on options which have too large of a bid-ask spread. So let's get to an example straight away. So here we are on the Interactive Brokers website. If you go to trading, platform demos, it's going to bring you to this page. Two demos platforms they let you use. One is the Trader Workstation, slightly more complicated for advanced traders, and the Web Trader, which is a simplified version. So we're going to click on that. We're going to try the demo here. So we're in the Interactive Brokers platform. It's a demo account, so it's a great place to practice trading. We're in the order management window, and on the right hand side you're going to see spread. So we're going to click on spread, and you can see an option strategy window opens up with a drop down menu. So we're going to pick on Strangle, and we're going to type in Microsoft as the underlying. So we're going to do a practice trade on Microsoft. So you can see two order windows open up because it's two trades in one really. Now the action here is to buy, but we're actually selling. And you'll notice that the corresponding trade, second trade, has also changed to sell because remember, we're selling a call and a put. We'll change the expiry to the 19th of June. And let's pick the $50 strike for Microsoft. And let's pick the $47 strike for the put option end of things. Okay, so we can see here that we've a bid-ask spread here in Microsoft. It's only 2 cents on one side and 3 cents on the other. And that's what we're talking about, tight bid-ask spread. So they're fairly tight. And you notice that we're going to be selling both options. So we're going to get the bid price. So we're going to get $1 for the call side and we're going to get 84 cents for the put side. So it's 184 in total. So the next line is your order screen really. So it's a credit spread. It's one quantity of one and our net price is 184. So we're going to get $184 in per contract because options are bought and sold in contracts and one contract controls 100 shares of stock. We always place a limit order here. You always dictate the price you want to get for your credit. And our time in force is a day. We don't do a good to cancel order in these type of trades. The reason being the trade may not be viable the next day. So it's only viable at certain times. So we click on preview order. We get a last chance saloon here. You sure you want to sell one $50 call and sell one $47 put? And we do. So we click on submit order. So that order has gone into the system. We click on trades and we're going to see that that order has been filled. So the next thing what we do is we go and look at our positions. You're going to see the positions being updated. And there we have a short $50 call and a short $47 put. So that's what a short strangle is. And basically we would want Microsoft to trade between $47 and $50. That's why that trade is placed. Let's get to a real life example that we did in our own account with IBM. So here we have a real life example. IBM was trading at $164 on the 20th of April. Earnings were being reported the next day and implied volatility was extremely high because of earnings. So what we did, placed a trade in the expectation that implied volatility would fall after earnings. So our first trade was to sell the May 15th $147 put and we got 40 cents a share in. And the second trade was to sell the $177.50 call and we got 38 cents a share in. So our net credit was 78 cents a share or $78 per contract. So why did we place this IBM trade? Well, as we said, implied volatility was high and we expected it to fall after earnings. So here's a chart, the best way to explain it to you, and we've charted implied volatility. Here's April the 20th when implied volatility was high. After earnings, look what happened to implied volatility. It fell off the cliff. So in other words, we were selling options when implied volatility was high and buying them back when implied volatility dropped. So what's the risk in a trade like this? Well, it's undefined. If you think about it, technically you've insured the value of somebody's shares to the tune of $147 with the short put. So if the shares fell to zero after earnings, you'd have to stump up $147 per share, and then they could rise forever and ever and ever to infinity. And of course, you then have a short call, which basically means you have to sell the shares to somebody else at $177.50. However, we need to get real here. It's highly unlikely that the shares of IBM would fall to zero, and it's also very highly unlikely that the IBM would rise substantially by your expiry date. So we give ourselves in these trades plenty of leeway for the trade to go wrong. We'll explain that later on. But before we go on, we want you to remember position sizing. It's really important that you trade small and you trade often. Too many people starting out in option trading put on way too big a size on a trade, and if it goes wrong on them, they find it hard to recover. So if you trade small and trade often, you'll do just fine. So on the short strangle, what's the max profit you can make? Well, you achieve your maximum potential profit when the share price finishes between the short put strike price and below the short call strike price. So in the case of IBM, that was between $147 and $177.50. They were the two strike prices we picked. So if the share price finished somewhere between those two, we'd make full profit, and that was $78 per contract. What were our break-even points? Well, with the short strangle trade, there's two break-even points, and they're calculated by taking the short put strike and taking the credit off that, and then if it finishes below the short call strike plus the credit received. So our break-even is actually 146.22 to 178.28. So in other words, if the share price trades between 146.22 up as far as 178.28, you will still make money. Partial profit. So as you can see here, our max profit is achieved at the two strikes that we picked. But below this strike price here, the 147 strike, we still achieve profit when the shares finish between the break even, which was 146.22 and 147. And then on the upper side, if the shares finish between 177.50 and 178.28. So that's how you get into a partial profit position. So what do we talk about trade leeway? Well, don't forget the share price of IBM was $164. Now, we know that our break-even points are 146.22 and below 178.28. So somewhere between there, we make our full profit. Now, the share price can then fall 17.78 because the share price was 164 minus the 146.22 is 17.78. So they could fall 11% after earnings or rise 9% after earnings, and we still make a profit. That's why it was such a high probability trade. So what is the effect of volatility on a trade like that? Well, the decrease in implied volatility has a really positive effect. We showed you the chart on that. And an increase in implied volatility has a negative effect. So note that we placed this trade when implied vol was high. Again, time decay, so theta, it's just a dollar amount for how much your options devalue every single day. That's positive for a trade like this. Don't forget, we've sold time, we've sold theta. So every day that passes by, theta has a positive effect on our trade. So how do you go about picking strike prices? Well, this really depends on you and how risky you are as an investor. So the closer you pick your strikes to the share price, the more premium you're going to receive, but you're taking on a greater risk because it's a greater potential of one option finishing in the money. So the further you go out of the money, the less premium you're going to get. So you're not getting rewarded as well, but you're also taking less risk. So you can dictate what type of risk and reward you want to take on a trade. It also depends on the potential move of the underlying share price. Some stocks are less volatile than others, and this really boils down to standard deviation. And the rule of thumb, you're not going to have access to a lot of this information, is to pick at least one standard deviation from the share price. So I'm not going to get too complicated for you guys here. But An easy way for you to pick this out is really to place trades with at least a 75% chance or more of success. My rule personally in my own account is over 80%. So you can actually get probability of success calculators with a lot of trading software that's out there. Any good platform that's offering options trades really should have this type of software there. I'm going to show you how you would actually go and get it from Interactive Brokers. So here we are back in the Interactive Brokers website. We have a probability lab demo. So we click on try demo. And you can see here it's automatically populated what's come up. So we just did a trade on Microsoft. We're going to type in MSFT. You pick the expiry that it's gone out to, and it's going to tell us now in a moment what is the probability of Microsoft finishing at certain ranges. So for example, the chances of Microsoft finishing below 46 here is 19%. So in other words, it has an 81% chance of finishing above 46 by the 19th of June. Then on the upper end, they're saying here there's an 80% chance of it finishing below 50. So there's only a 20% chance of it finishing above 50. So this is a great way for you to be able to calculate what your probabilities of success are. So don't forget, you've got to look at the combination of both of the trades. So if you pick the 45 strike here, you've an 11% chance. And then let's say if you pick the 51, you've also gotten about 11% chance. So combined, when you take the credit you received into consideration, that's about an 80% probability there, the 51-45 strike. So that's how you would calculate your probabilities of success. So really, really important for you to look at your probability of success. Don't get too greedy looking for higher premiums. Have a higher probability of success. You're more likely to win. So how did we manage that IBM trade? Well, the very next day, as you can see, the shares didn't move that much. We normally close all of our trades, that are 50% in profit. We don't wait till expiry on any of these trades. When we get into 50, maybe even 30% profit, we take the profit off the table and move on to the next trade. We actually closed the IBM trade the very next day, and we made a profit of $272. So there was a 70% of our max profit. So we were happy to walk away. So in one day, that trade, we made $272. So take your winners at 50% and move on. That's the rule of thumb. But what about managing a losing trade? Well, there's two potential loss options. If the shares finish above the higher strike, and the shares finish below the lower strike. So we've done a separate tutorial on that, and how you would actually go about managing a trade. And we've two great examples in our own account. We had one trade with Twitter and one trade with Yum. Both of them didn't go our way. So to give you an example, in a month we placed about 20 trades, and out of the 20 trades, 17 of them were clear winners and 3 were managing. And we're going to show you how we would manage the Twitter and the Yum trade. So that's in a separate tutorial which you can do after this particular video. So guys, this option training, it's free. Please share with your friends via all the social networks. It doesn't cost you anything. Visit our website, sharenavigator.com. Thanks. This is Stephen. Bye for now.